Today we are discussing a key element of M&A deals, working capital adjustments. We will explore what this involves and the typical challenges that arise. Firstly, what is working capital? Well, working capital is the difference between current assets and current liabilities. Current assets broadly comprises of all the assets that are expected to turn into cash or actual realized value within 1 year. This includes cash, inventory, account receivables, and prepaid expenses. Current liabilities, on the other hand, comprises of all the liabilities that are required to be paid within 1 year. This includes short-term debt, current portion of a long-term debt, account payables, and accruals, for instance, payroll-related expenses. In M&A transactions, ensuring that a business you are buying or selling has adequate working capital is absolutely crucial and needs careful consideration and adjustments to reflect the true value of the business at closing. The primary goal being to ensure that a business can operate normally after the completion of the transaction without the need for an immediate cash injection from the buyer. Equally, from a seller's perspective, unless the seller has the benefit of any upside from the excess working capital, the deal would not be fair to the seller. It's about fairness and accuracy in the transaction pricing, which is at the heart of working capital adjustments. For buyers, there are three key objectives which a working capital adjustment serves. Firstly, it preserves the value of the target and equitably allocates risks. Secondly, it protects against value erosion and value leakage until closing. And thirdly, it provides better protection than warranties and indemnities as they entail time and cost for enforcement. From seller's standpoint, working capital adjustment provides potential for upside if the cash or working capital position improves in the period up to completion. Some of the key challenges and issues involving working capital adjustments are that firstly, buyers and sellers often clash over what constitutes net working capital and current assets and liabilities. For example, one party might want to include prepaid expenses while other might not. Secondly, a big and major concern and worry for buyers is that sellers might alter normal operations to inflate the sale price by delaying payments, speeding up receivables, or maybe even putting off necessary expenses. This could compel the buyer to spend more post-purchase. Robust operating governance can address this issue appropriately. Thirdly, normalized working capital and how it is defined can often lead to disputes. This involves agreeing on what is typical for the business and removing any anomalies from the calculation. Fourthly, the timing of the closing can impact many components of working capital. For instance, if a business is seasonal or cyclical, the required working capital at closing could vary significantly. Fifthly, the optimal working capital ratio can vary significantly across industries and sectors due to differences in business models, operating cycles, and capital requirements. Benchmarking this ratio against industry peers is crucial, recognizing that it depends on industry norms, business models, and sector-specific requirements. Sixthly, differences in how account receivables and inventories are valued can create disagreements. For instance, impaired or old inventory and bad debts are often points of contention. Lastly, from a regulatory standpoint, any amount which is paid after the purchase price adjustment by a non-resident to a resident must comply with the pricing guidelines. Also, under Indian foreign exchange laws, only up to 25% of the total consideration can be deferred up to 18 months from the date of definitive agreements. To address all these issues which I have enumerated today, clear and comprehensive working capital contract terms in agreements and thorough due diligence are absolutely essential. Both parties should agree on working capital formula, definitions, timelines, and modalities for such adjustments early in the negotiation process. Additionally, using a neutral third-party auditor or an expert accountant as an expert can help resolve differences. I hope you found this video helpful. Do let us know if you have any questions on this topic. Thank you for watching this.